So replacement of an asset. So under the single account system, when a new asset is replaced in place of old one, the old asset is written off and the new one is capitalized. But under double accounting system, okay. So what is double accounting system? So question number one. So another thing, see here the difference between total cost of entire work and the estimated replacement cost of an old asset in original manner is charged to capital account. So what is capital account? Again another doubt. So before going to the replacement account, the replacement of an asset, we have to, it is very needed to know about the double accounting system and what is capital account, what is the revenue account. So let us go back to the double accounting system. So double accounting system, it is a method of presenting the final accounts or financial statements. Double entry system is different. That is a bookkeeping system. But double accounting system, it is a presentation. It is a method of presentation of final accounts. Final accounts of the public utility companies like electricity companies, railway companies, gas, water supply. So these companies are formed by a special act of parliament. So how this double accounting system works and how we have to prepare the final accounts under double accounting system. So final accounts. So in these final accounts, profit and loss account and balance sheet, we know very well. So this profit and loss account will be in two parts. So first part is revenue account. Another part is, second one is net revenue account. What is the difference between revenue account and net revenue account? So revenue account is similar to the profit and loss account. Net revenue account is similar to the profit and loss appropriation account. So revenue account, all items of expenditure appear on debit side, where all incomes appear on credit side of the revenue account. Okay. And the net revenue account, similar to the profit and loss appropriation account, but it should be noted that the interest on loans, debentures are treated as an appropriation and therefore debited to this account. So whatever the appropriations, we have to debit. So this is done because debentures and loans are considered as a part of capital of the concern. Part of capital of the concern. So one more thing we have to know about the depreciation reserve. Depreciation reserve. Generally we charge the depreciation in the profit and loss account. And we deduct it from the asset value. But here in double account system, we prepare two parts of balance sheets. So prepare the balance sheet in two parts. The first one is capital account and the second one is general balance sheet. So what items comes under the capital account? So capital account, it consists of capital related transactions. So capital related transactions. So say for example, equity shares, it is a capital. Preference shares issued, it's a one of the part of capital. Securities premium, all capital related. So these are all sources. With these sources, we received amount. So that is why in the receipt side, in the sense credit side of the capital account, we mention all these capital receipts. By using these capital, how we are utilizing on fixed charges like purchasing of land, building, mains, transformers, motors, meters, so preliminary expenses. So how we are applying these funds in the capital expenditure. However, this capital account, it contains three columns in each side, three amount columns in each side. So first column represent receipts or expenditure at the end of previous year. It is nothing but opening balance of asset. So, or it may be the ending balance of the previous year. So expenditure at the end of previous year, receipts at the end of previous year. So another column represents receipts during the year. Here in expenditure side, debit side, expenditure during the year. The third column represents total capital expenditure to the date. So by adding these two, opening plus during the year, we'll get the total. So likewise, we have to prepare the capital account. And see, whenever we have a balance in the revenue account, so whatever the profit arises in the profit and loss account, it will be transferred to the profit and loss appropriation account. Likewise, we have to transfer the amount to the profit and loss appropriation, in the sense net revenue account, by balance brought down. If it is a negative, we have to show it in the debit side. Okay. So this net revenue account balance, if it is positive, we have to carry forward to the general balance sheet. That is part 2 of the balance sheet. Till now, we discussed only part 1, capital account. So this one, this net revenue account is transferred to the part 2 of the balance sheet. Okay. So in the part 1, whatever the total we get from expenses side and receipt side, okay, we just simply transfer it to the general balance sheet, the total expenditure. The total expenditure. So these are all the capital charges, capitalized. So we utilize the funds, we utilize the capital, we applied capital to get these capital expenditures. So land and building, plant and machinery. So all are fixed assets. In the sense, total expenditure comes under the asset side. So total receipts of the capital account comes under the liability side. Okay. So the net revenue account also will show it in the liability side. So in this general balance sheet, we record current assets, current liabilities. Together with these balances of total of each side of the capital account. So likewise, we discussed. And certain other items, example, any kind of reserve, general reserve, capital reserve, depreciation fund. So any kind of funds like depreciation fund, um, replacement fund also appear in the balance sheet. Here in double accounting system, we are just splitting the accounts. So profit and loss account into two parts, that is revenue account and net revenue account. Balance sheet is in two parts, capital account and general balance sheet. So likewise, we have to prepare. So another important concepts in these final accounts are, so why we have to maintain. So adequacy of capital is the important concept. So in case of public utility companies, this see this is because firstly a large amount of capital is usually required to be invested. See, to invest in various capital expenditure, a large amount of fund is required. So, in the manner in which capital has been raised, so how we raised this capital? Generally, equity portion should be 30% and debt portion should be 70% when it comes to the electricity companies. So more than 70% of debt is allowed, but more than 30% of equity is not allowable. And if it is more than 30%, that remaining portion will consider it as investment. And 14% of return we have to calculate on the extra portion. So likewise, it is very essential to maintain a procedure or a manner in which capital has been raised. It can be quite important factor for stability of the concern. So unless business is adequately financed, it may at any time run into difficulties. And say for example, if a concern has raised a part of its capital in the form of bank loan, or deposit, it may have to be repaid after some time. In the sense, financial risk. So it involved financial risk. However, it can be avoided with the alternative arrangements. It can be avoided with the alternative arrangements. So we have best example with the depreciation also. Okay. It is also important that public utility concern once started should continue to work permanently. Such a condition can be ensured only if the undertaking appropriates sufficient amount. So the undertaking must appropriate the sufficient amount of it out of its profit. In the sense, it should keep aside some amount for the future purpose. What kind of future purpose? So nothing but reserves or funds. So what kind of funds are those? So just now I told you depreciation. See, a provision for depreciation was not required to be made out of profits. Instead, only ad hoc provisions are made by appropriating amounts out of revenue to the credit of depreciation fund. See, initially we charge the depreciation to the profit and loss account. In the profit and loss account, we charge it against the profit. And then we are not going to reduce it from the asset. We'll just maintain a depreciation fund in the liability side. So ultimate effect will be the same. But the thing is, we have to maintain the asset value in the capital account. So capital account, it consists of uh, fixed assets like land and building, everything. In general balance sheet, so in the general balance sheet, current assets and current liabilities will mention. Say for example, if you consider this as a single account, so all items related to the capital and current assets and current liabilities, everything will be in the same single balance sheet. So if you charge the depreciation, in the sense, if you reduce the depreciation amount from the fixed assets, so you will show the remaining balance of the fixed asset. Instead of doing that, you just maintain a depreciation fund in the liability side. So fixed asset value will be the same from the beginning. It is not going to be changed. And this depreciation fund, it creates an effect that it will reduce the overall effect. So the effect will be the same, but the procedure you are applying is the different thing. Okay. So likewise, replacement of asset is also same. Why like that? Because in the replacement of asset, what we do, we just replace one asset with the new one. We are taking out the old one and we are inserting new one. Instead of doing that, what this double account system is suggesting is we have to maintain old asset cost, and whatever the extra charge for the new asset, we are just mention only that extra cost in the balance sheet, in the capital account. So if you do like that, two assets will be there. So as a result, abandonment of assets, in the sense, whatever the asset running out of life, so that asset also will keep the on cost, will keep it at cost, at original cost. So treatment of capital losses. Under pure double account system, it is not necessary to write off losses on capital account suffered as a result of abandonment of assets, which have run off their normal life and are not to be replaced. Thus, assets which are no longer in use or which have no value to the undertaking continue to be shown in the capital account at their full original cost. See, this is what I explained now. So, if we write off losses on capital account, in the sense if we reduce the amount in the capital account, it suffers abandonment of assets. So, either it is not useful and it is not to be replaced. But if you keep both, so if you keep both with the original cost, it will affect efficiently. However, in practice, it is usual to provide losses in the respect of such assets by making suitable provisions as a charge against profits. So, whatever the loss occurred in this portion, so this portion is stating about we have to keep the both assets, in the sense old asset also we have to maintain with the full original cost, but loss is there, such kind of loss will charge it against the profit. So in respect of such assets, by making suitable provisions as a charge against profits, so it is in practice. So these provisions are shown in the general balance sheet. So likewise, I told you the depreciation. So depreciation fund will show it in the general balance sheet liability side. Okay, depreciation is a loss of asset, but we are not reducing the amount in the capital account. So financial statements of electricity company. So every electricity supply company is required to submit to state government contain statistical statements in the prescribed form according to the Rule 26 of the Indian Electricity Rules 1956. So as a result, every electricity company must submit their annual accounts as per the prescribed format within 6 months from the date of okay. So these are the statements prescribed in the Indian Electricity Rules 1956. So if you observe these statements, the statement of shares and loan capital. So this is for only, this is a statement where we have to show only shares and loan capital. Statement of capital expenditure. So how much capital we incurred for the expenditure in the purchase of fixed assets. Long term capital expenditure is nothing but a long term investment. So statement of showing written off. So each and every particular item divided into statements. So if you do observe, see, we are just discussed about the revenue account and net revenue account, okay, capital account and general balance sheet. So revenue account and net revenue account. See, what are the statements? Statements of operating revenues and operating expenses. Operating revenues and operating expenses we are mentioning in the revenue account. Statement of net revenue and appropriation account. So we are preparing net revenue account. So statement of share capital and loan capital plus expenditure. So capital expenditure we are mentioning in the debit side of the capital account, and share capital and loan capital we will mention in the credit side of the capital account. So general balance sheet. General balance sheet is the same, which contains current assets and current liabilities. Along with those, we had we have to mention the reserve funds. So this is about the double account system. So by using this information, we'll prepare the final accounts. Okay. So coming to the replacement of an asset, now we can understand the terminology which are used in the this particular topic. So under the single account system, when a new asset is replaced in place of an old one, the old asset is written off, the new one is capitalized. But under double accounting system, the procedure is first one. There is no need to write off loss when the asset is abandoned. That is, the depreciation is not charged to the asset account. Instead, the amount is credited to the depreciation reserve account, depreciation fund I mentioned. So in other words, the asset will continue in the books at its book value. As I told, we are not going to reduce the depreciation from this asset, from the particular asset in the balance sheet, but we have to maintain the book value in the capital account. The value of asset will increase as soon as extension, in the sense replacement, happens. So the value of increase, we'll mention it in the capital account. So therefore, allocation to the amount spent is to be made between capital and the revenue. So the value of extension is the capital, and the actual current cost of replacement of a original asset is the revenue charge. So how to evaluate the capital charge and how to evaluate the revenue charge? See, original cost of the asset will remain unchanged. So as I told, so in the capital account, we are not going to change the amount. We are not going to reduce the amount with the depreciation. So it is unchanged. Second one, revenue charge. How much we have to charge against the profits in the revenue account. So the estimated cost of replacement of an old asset is ascertained. So how much cost is the present cost? Estimated cost means the present cost of old asset. You may be purchased one machinery 10 years back. What is the current cost of that asset? So today's market value or price index, whatever it may be. So today's value of the same capacity and same model, what is the value of that product today? So that is the estimated cost. So if any conflict, see, some engineers estimate this cost of replacement, like by comparing the market prices and the price indexes. If any conflict rise, see, generally the estimated cost they will consider either market prices or from the price index. So in both cases, conflict may rise. In such case, we have to take lesser amount. We have to take the lesser amount on the basis of conservatism principle. Okay. So the estimated cost of replacement of an old asset is ascertained. At the same time, it is reduced by sale proceeds of old material. See, we are replacing the old asset. So that asset value, what is the today's value of that asset, old asset, and if we sell this, how much we realize? In the sense, the cost will be reduced, right? We have a car. So if you purchase that car, see, you purchased car 10 years back, say for example, and now that car market price is different, the same model. Okay, price may be increased, same model, same capacity, no change. So the price may be increased. Okay, but you don't want to use that car. If you sell that car today, after 10 years, will you get the market price? No. Will you get the purchase price? No. Maybe lesser amount. Maybe sold like a scrap. You can realize it. But what we generally think is, today that car value is 40 lakhs, and I sold that one, I got only 2 lakhs. So roughly 38 lakh is my cost, estimated cost of replacement. In the sense, we have to reduce the sale proceeds of old material. Likewise, any value of material reused in the reconstruction, that value also we have to deduct it. So the balance amount will be charged to the revenue account. That is called a revenue charge. So what about the capital charge? So estimated cost of replacement and the new work or new asset cost. So we are replacing it, right? So whatever the new car, it is around 60 lakhs. New model, say for example, new model 60 lakhs. But you sold that for 2 lakhs. So remaining 38 lakhs, you are estimating that is the cost of replacement. So the difference amount, in the sense 60 lakhs minus that 38. So how much it is? 22 lakhs, the difference amount, 22 lakhs. That 22 lakhs you have to bear out of your pocket, right? Likewise, we have to calculate the capital charge. Okay. So in addition to the above, additions or improvements are capitalized. Auxiliary main. See, auxiliary main. See, I'll tell you with the example. Auxiliary assets are any abnormal expenditure for repairing any existing asset. Say for example, a track of 80 kilometers, a track of 80 kilometers. 50 kilometers is totally replaced, but 30 kilometer is repaired. Thus, the track of 30 kilometer is called a auxiliary asset. In the sense, we can repair it. We can repair it by using old material also. So it works like a supporting asset. The track of 50 kilometers is called new asset. So we are just repairing the portion that is called auxiliary portion of asset. Okay. So okay, we can learn these journal entries while solving the illustration. So illustration 1. So illustration 1, an electricity company laid down a main. So main in electrical companies, some mains they will use as an asset. So main asset at a cost of 16 lakhs. Some years later, company laid down an auxiliary main for one fourth of the old main. So one fourth of the old main they are utilizing as a auxiliary main. In the sense they repaired it at a cost of 6 lakhs. So one fourth it get repaired. So what about the 3/4? So it also replaced the rest of the length. Rest of the length, in the sense 3/4 length of old main replaced at a cost of 18 lakhs. So 3/4 they replaced with the new asset, and 1/4 with the auxiliary asset. The cost of material and labor having gone up by 15%. Sale of old material realized 40,000. Old material valued at 40,000 were used in renewal, and those valued at 60,000 were used in auxiliary main. So 40,000 sale, another 40,000 used in renewal, used in renewal. So another 60,000 used in auxiliary main. So in the sense, the 6 lakhs it involved 60,000 of material. So the remaining portion of repair company paid with the cash. So show the journal entries for the recording the above transaction. Show working notes. Okay. To solve this, we have to find out the revenue charge and the capital charge. So first of all, we'll mention all the details given in the illustration. So main cost 16 lakhs. Out of this, one fourth, in the sense 4 lakhs. Out of 4 lakhs replaced with 6 lakhs, and 3/4 replace 3/4 is 12 lakhs. See, the cost of material and labor having gone up by 15%. So at the time of replacement, these are the things we have to carefully observe. The cost rise, we have to calculate against the 3/4 of replacement asset. So 1,80,000. We have to add it to the 3/4 of asset. So total cost involved 12 lakh plus material and labor involved 1,80,000. So that is 13,80,000 rupees. It is involved and this amount of asset is replaced with the 18 lakhs. Okay. So another information is sale of old material 40,000, old material used in renewal 40,000, and old material used in auxiliary means 60,000. So first of all, we have to find out the revenue charge. So estimated cost of replacement. Estimated cost of replacement. So current cost. So current cost of old asset. See, 12 lakhs is the 3/4 one, and the cost of material and labor having gone up by the 15%. In the sense, in the present days, the cost of material and labor is different. So it is raised. So it is simply stating that we have to estimate how much cost is involved in the old asset. So estimated cost of a replacement of the old asset is 13 lakh 80,000. So this is the cost of replacement. Out of this cost, as I told you, the present cost, the current cost means we are estimating the car value. I told you the example of car. So we are just estimating the present value, and after sale we got 40,000 from sale. So that amount we have to reduce this, because we have to know the exact cost, right? So old material in renewal purpose 40,000, and old material in auxiliary main 60,000. So these are all we utilized for, and the remaining balance is charged to revenue account to write off these things. Okay. In the profit and loss account, in the sense revenue account, debit side, we will mention this loss. This is the loss we are estimating. And capital charge. Without disturbing the original cost or book value of an asset, we have to evaluate the capital charge. So how much portion we have to, how much amount we have to mention as the new asset, new main. Okay. So the difference amount, as I told you, see, the difference between total cost of entire work. So total cost of entire work is 18 lakhs. Entire new work. Total cost of entire new work 18 lakhs. And the estimated replacement cost of old asset in the original manner. So estimated cost of old asset, that is 3/4 of old main plus increase in cost, nothing but 13 lakh 80,000. So the difference amount 4 lakh 20,000 we have to maintain, we have to capitalize, we have to mention this amount in the capital account. Okay, so this is very simple. Only we have to estimate the cost of old asset. Okay, so how to pass the journal entries for these transactions? So total replacement cost, that is 13 lakh 80,000. See, being current cost of replacement of 3/4 main charge to replace account. So replacement account data to bank account. So 13 lakhs 80,000. So another one is being cost incurred on laying auxiliary main, including old material worth of 60,000. So for the repairing purpose, one fourth of asset, so it costs around 6 lakhs. In this 6 lakhs, 60,000 was used in the sense old material we used in auxiliary main. 60,000 worth of old material we used it, right? In the sense the remaining 5 lakh 40,000 we pay by cash, and 60,000 we used material. So the entry will be auxiliary main account debtor to bank account 5 lakh 40,000 to replacement account 60,000. See, see, and new main. So whatever the capitalized amount, how much we have to capitalize? 4 lakh 20,000. Out of 4 lakh 20,000, see, 40,000 we used old material for renewal purpose. For renewal purpose we used it, right? So the remaining exact cost, cash cost, we have to pay by cash 3 lakh 80,000 only. So in the event of sale of old material, bank account debtor, replacement account. See, if you observe these journal entries, wherever the old material involved in entry, that name comes as replacement account. So, old asset cost, see, estimated cost of old asset. So, to bank account. So, we are mentioning replacement over here. And in auxiliary main, old asset used 60,000. So, we mention with the replacement account. So, in the new main, 40,000 we used old material for renewal purpose. So we mentioned replacement account. See, sale of old material, we realized bank account debtor. See, replacement account. So if we prepare replacement account, so bank account, the current cost of replacement debit. So another auxiliary main account, see, bank account 13 lakh 80,000, and by auxiliary main account 60,000, see, by auxiliary main account 60,000, by new main account 40,000, by bank 40,000. So the balancing figure we have to transfer it to the revenue account. It is nothing but revenue charge. We already calculated here revenue charge. Okay. So this is how we have to calculate the replacement of an asset.